Our market master for the day joins us, Prabodh Agrawal, President and Head of Research at IIFL Institutional Equities. He's joining us from the sidelines of the IIFL Investor Conference. Good morning, Prabodh. Thank you very much, in particular for finding time for us at what should be a very busy hour for you. Well, actually take us through the investor mood at the conference itself. Are you getting a sense that, the markets will weather the budget and we are not going to see big falls? Because expectations are really running high. So what's the texture of the market's gains at this point in time? Holdable?
Yeah, good morning, Lata. I would say the investor mood is quite positive. Of course, we have just started our conference, so it's a bit early. But from the interaction that we have been having with the investors even prior to this conference, I would say that people are looking for more buy ideas rather than sell ideas. People may hold back their purchases for a while, given that the market has had a good run before the budget. So I would think that the market could well go through a soft patch or a consolidation phase in the near term, in the run-up to the budget, and immediately after the budget. But let's not get distracted by that. I would think that that provides a good sort of way to position for a medium to long term. I really don't see, to answer your question, I don't see a major correction. I've always held that the correction at the index level is unlikely to be more than 4-5%. And of course, individual stocks can correct more. But these are the times when one could actually increase the position.
Okay. Prabodh, hi, good morning, and thank you for joining us on the show. It's interesting that you say, one should not get distracted by the budget. Nevertheless, what is the expectation from the budget itself? What are the 2 or 3 things, if the government delivers, will make the markets enthusiastic? Yeah,
I would say, of course, the 3 or 4 things that we, generally the investors are expecting. One is there should be increased spend on the physical infrastructure. That's a common sort of expectation for most investors. So the government should be spending more on roads, on ports, on airports, on metros, on dedicated freight corridor, on the industrial corridors, etc. Because the private balance sheets are weak, and therefore at this point of time the government has to take initiative and increase the expenditure. The second expectation is that the government should also be spending on social infrastructure, especially education and healthcare. The third, I wouldn't say expectation, but the third, one would expect that, this increased spending has to be somewhat funded through increase in tax rates. So I would not rule out the possibility of increase in tax rates in certain areas, for example, service tax or many of the exemptions and concessions being taken away. The fourth area, I would say, would be that the government should be looking to target the subsidies much better. A lot has been done on the LPG side, where 60% of LPG connections all over India are now connected to their bank account. I would think that in this budget, we would need a more clearer roadmap of what the government proposes to do with the rest of the budget, subsidies and the social spending in terms of direct transfer of benefits. So we need more direction on that. And last but not the least, the expectation is that the government would do something to recapitalize the PSU banks. That is one area. We are all expecting a recovery. The recovery has to be funded through bank lending. We know that the PSU bank balance sheets are not in a good shape, and therefore the government has to recapitalize them in a major way. So I would say these are the major expectations, and if these are delivered, of course the markets would be happy.
Okay, well, one of the more fundamental issues is where will the money come from? You did speak about an increase in service tax, probably. Even giving a fairly decent buoyancy for service tax, it is still, a smaller of the many taxes. Therefore, do you think the market will take it kindly if the market borrowing or the fiscal deficit number came in higher than expected?
See, I would think, again, this has been deliberated quite a bit, that, the government can afford to loosen a bit on the fiscal deficit target of, say, 3.6% for next year. But I think, the government, this is a very sort of tight rope walking for the finance minister. But I think, a reasonable amount of spending on the physical and social infrastructure is possible. with all the subsidy that the government has saved on the fuel side, the excise duty hikes which have happened, and with some more cutting down on the revenue expenditure. So yes, a bit of slippage would not be would be looked upon as a concern by the market, and I don't think even the rating agencies or the RBI would look at it as a negative and therefore would impact their credit assessment of the country or the monetary policy of the RBI.
I can take your point on credit rating agencies, but I'm not so sure of RBI. Repeatedly one hears the words high-quality fiscal consolidation. But separately, one of the big news or expectations doing the rounds is that housing can be used as a kicker for growth because it has shown the potential in other countries of a huge multiplier effect. Anything you are expecting on those lines? And as a stock market investor, how would you approach this expectation?
Yeah, so affordable housing has been a thrust area of the new regime, ever since the beginning. And of course, the government has put aside some funds, but I see more being set aside for affordable housing. After all, the target of the government is to provide a housing for everybody by 2022. So more needs to be done. That can be done in a variety of ways. Of course, the banks committing to more funding of these kind of projects, but also, allowing more leeway to builders in the form of FSI and, allowing them more FSI in areas where they desire in lieu of the low-cost affordable housing, etc. But clearly, you're right, the housing segment is one where we see major thrust, not only in this budget, but over the next 3 to 5 years.
And so how do you play it?
And the way to play the market, the way to play the market, I believe that the housing loan segment will boom. We have seen the housing loan segment being robust over the last 2-3 years, even when the rest of the credit growth was tepid. And but I see a major growth in that segment. So I believe the housing finance companies are a good way to play. There are some real estate companies also which are very strong in housing. Of course, in the real estate sector, there are very limited players, companies which have decent balance sheets and governance. But I think these are the two segments, the housing loan as well as the real estate sector.
Okay, that's about the housing sector. What are the other expectations sector-wise from the budget this time around, and pockets where you think that there's still value?
See, the other segments we like the financials. I think, while the financials have run up quite a bit, but I would still feel that the growth can surprise us on the upside. And we are going to see robust growth, I would say 20-22% profit growth for the large banks over the next 3 years, and between 25 and 30% growth for the smaller banks and NBFCs over the next 3 years. So finance sector is one we like. The other segment we like is industrials. Companies which are strong on the EPC side, on the road side, on the transmission distribution side. The third segment we like is the auto segment. I wouldn't say they are value biased because the stocks have had a good run, but as the consumer demand picks up, the petrol prices are already lower, interest rates are beginning to decline, so it's good time to be owning a vehicle, and so that segment I expect to do well. And lastly, the cement sector, which should be beneficiary of the construction sector.
Okay. Well, you referred to public sector banks. Prabodh, we've not seen the government very generous with recapitalizing the banks this year. In fact, they've even said that they'll only encourage the larger or the better run banks, almost prodding the other banks to consolidation or benign investor neglect. So what is your pick of the pack?
Yeah, so we have always been skeptical about investing in the PSU banks. If you look at, we track close to 14 PSU banks, and even after the good run that we have had over the last 1 year or so, 11 out of these 14 banks continue to trade below book. So the reason for that is because these banks do not have the risk appetite, they are undercapitalized, they are burdened with large stressed loans, including NPAs and restructured loans. and we definitely know that they need to raise capital, which means that the existing shareholders will get diluted, whether the government puts in money or whether they raise from the market. So with all this, we have always considered them as probably short-term tactical plays, but not really investment plays for the where one can take a view for 2 to 3 years. So we continue to like the private banks and NBFCs and one or two large PSU banks, but the others we are not very keen.
Okay. Yeah. Okay. I just wanted to ask you how are you approaching earnings? Because I was going through a report earlier by JP Morgan where they said that they believe that the equity markets are not vulnerable to the earnings cut. So they believe that there is a divergence between the equity markets and earnings, and that divergence is here to stay. Would you concur with that view?
See, actually, if you look at the consensus is expecting about 18% growth for Nifty for FY16. That is the consensus, Bloomberg consensus expectations. For the current year, the growth that we expect is about 8 to 9%. So there is a significant pickup in earnings growth that the market is expecting next year. Now, if you put that in perspective, the last 5 or 6 years, we have seen single-digit earning growth or low double-digit earnings growth. So in that context, the 18% growth is very high. But I would not be too concerned that or looking at the 3Q numbers or 2Q numbers that the 18% is unachievable. See, what we must also understand is that we are at a cyclical low. If you look at the BSE 500 companies, on most parameters, we are at a multi-year low. For example, the EBITDA margin is at a 15-year low. The PAT margin is at a 15-year low. The ROEs have halved in the last 7 years. The debt to equity is at a 15-year high. So the point I'm making is that we are at a cyclical low, and the base is so low that the bounce back can be very sharp. So while 18% growth may seem too optimistic right now, but I don't think it's a completely outlandish expectation. And even if the 18% suppose is not achieved and we end up the year say with low teen kind of a growth, I don't think the market will fall in a major way. If the earnings grow by say 13-14% in a worst case, I would still think that the market can grow by 10 or 12%. Your select sectors or stocks which can deliver higher growth can grow even more than the rest of the market. So even in the situation...
Let me hold you to that, Prabodh, before we let you go. If the market is 10 or 12% and some of them are going to be obviously outperformers, what are the outperforming horses? Stocks.
Yes, so outperforming horses, I believe. I believe there are 4 or 5 sectors which will do well. I talked about financials, industrials, auto, cement, and the other sector which we didn't talk about is IT. These are the 5 sectors which I think will do well, and here the earnings growth will be better than the rest of the market, and I believe these sectors will outperform.
All right, so that's IIFL's Furious 5. Prabodh Agrawal, thank you very much for joining us, and have a great conference out there.